Happy Saturday, traders. It's Julian here, and today we are talking about trend extension or overextension. And what I want to talk to you about in this particular video is where the best place to get into a short-term trend is, especially on the day trading side of things when we're scalping, and where we want to get out and where we most certainly do not want to get in. Now, again, this is all my personal opinion, and a lot of what I'm going to be talking about comes through personal experience and where the higher probability risk to reward trades are versus getting in with low rewards and a high area of risk. So I just want to go over the concept of overextension on plays. Now, there's one thing that I talk about a lot, and that's what's called, reversion to the mean. For day traders specifically, you will find that a lot of day traders, myself included, use the VWAP, the volume weighted average price, which is this red line down through here. And you will see that on this this chart and the one that I'm going to go on and show you after this, price action does something very, very interesting around the VWAP. It will tightly wrap around that VWAP, like here. Okay, it's tightly wrapped, and what I mean is it stays very, very close to that VWAP. And it does the same thing over here, which is obviously known as consolidation. So you've got this consolidation with the VWAP cutting dead smack in the middle of that consolidation, right, on both sides. And then you get what's called you get a move, right? And what a move obviously is where price action steps away from the VWAP, and then we get into what's called an overextended area, something like this. This is a note of overextension. And when something gets overextended, gravity has to kick in, and price action has to come down, and it will generally come down and revert back to its mean. And so mean reversion is essentially price action steps off of a mean and then comes back down to it. And you'll actually see right through here that we chop through it right through here. We get on the other side, we find some VWAP support, we step off, we find VWAP support again. We break below, and there's a little bit of VWAP resistance, not really, but then we toggle up and down a little bit with VWAP again, offering us some support. So that is what's referred to as reversion to a mean. We take off, and we cap out at a level, and then we revert back to a mean. And so what I want to talk about, not only about the reversion side of things, but where is the best time to get in? And this, again, is my personal opinion. Now, just using a very simple pattern, which is a pullback, something like this, what you're going to notice right through in this area when you're getting long here on the breakout of that trend line resistance, is if we actually expand this box, you'll see something very interesting. And what that is I'm using this 9-day exponential moving average and this VWAP. And you'll see that price action is tightly wrapped around both. It's using that VWAP as support, and then we've also got this 9-day exponential moving average. This is generally a nice place to get long when that 9-day and that VWAP are tightly correlated. And what I mean is they are literally just side by side. And what we want to do is we want to position in before the 9-day steps away from the VWAP. So the higher the 9-day gets away from the VWAP, the less reward there is and the more risk there is. So the greatest reward to risk is going to be right through here. And you can see that reward to risk diminishes the higher and higher we get. And up in here, again, the higher we get, there is less reward and there is a greater amount of risk. So when I'm trading, and again, this is just me personally, what I like to do is I like to get into the areas that offer me the greatest potential reward with the least amount of risk. And what that looks like in this particular situation is a pullback, right? So it's a little dip buy. I'm getting price action at a discount. And ultimately what I'm looking at is I'm looking at my risk right through here. And then I'm looking at all of this as potential reward. Now you might ask me, how do you know that this is all potential reward? Well, that's going to be saved for another video lesson. But in this particular situation, you can see here that the reward or the risk, which is the difference between where I'm getting in and this area below the VWAP, to my reward, it's so incredibly skewed in my favor on the reward side that this is a trade that I will take every single time. The key takeaway from this is the relationship between how close the 9-day and the VWAP are. Now, I want to take this a step forward. If you would have missed this and it would have broken long, you do have another tradable opportunity right through here. It's a bullish pattern, it's a flag, it's got a small ascending triangle, but you have to understand that the risk is all the way down to the VWAP, because when you step away from the VWAP, you always have the chance that at some point you will see a reversion trade, and that is price action will come back down to the VWAP. Again, if you miss this opportunity, yes, this is an opportunity up here that you could get long, but the reward now is smaller than it was previous to this setup, and the risk has been increased. Okay, if we take it a step forward, again, there's a nice move right off of the 9-day exponential moving average, and the 9-day exponential moving average is holding quite nicely. But the risk is that you could get a reversion trade back down the VWAP, and again, you can see that your potential reward, it's not skewed in your favor, not like it was when this first started out. So there's your risk and there's your reward. Maybe a 1-to-1, not bad. A lot of traders will take that. But the real deal is that the best opportunity is right through here when the 9-day and the VWAP are close together. That is a very, very premature trend, and then this is referred to as a mature portion of the trend. And you can see that we get up to a high where price action then rejects new highs. You get a pin bar, you get a 3-bar reversal pattern, and price action can't push. You can also see that there's a turn in momentum. What happens? Price action steps down and it reverts back to its mean. And in this case, the mean is the 9-day exponential moving average. Now, this is for day trading. 9 and VWAP, pretty common combo. You will see that a lot of traders that are trading larger stocks in some cases will use 20 and 200s, and those are also quite good, but the 9-day obviously is a little bit more agile than a 20. So again, chief point here, best place to get into this is right where the trend is beginning to develop, and where you want to look at taking profits is in this upper area right through here, where you're getting signals that price action is going to move lower. Now, where you do not want to get out is the higher this thing moves, the less likely you are to reap a fantastic reward. So just, rule of thumb, something to keep in mind is the stronger the trend is and the higher price action gets, the closer it gets to a pullback. And when you've got a 9-day way over the VWAP like that, that is a signal that you could see a reversion trade very, very soon. And the last thing you want to do is be buying up into these highs only to get stopped out. Again, the real reward to risk entry is right down through here. Nominal amount of risk, exceptional amount of reward. Okay, so we're going to move over to OCGN. This is another trade that played out very well yesterday. And you can see that the same type of situation occurred. We've got a flat top breakout right through here, which is nice. And you can see that the 9-day and the VWAP are pretty close together. Now, this is a fantastic setup in terms of patterns, right? Again, you get this ascending triangle, flat top breakout. It's a flag right out of the open, and it's holding the 9 and it's holding the VWAP. This is a beautiful level to get long. But remember, the higher it gets and the more disconnected price action becomes from that VWAP, the closer you get to a reversion trade. So if we look at, there's the reward and the potential reward is up through here, and there's your potential risk. Ultimately, your potential risk is going to come at this level right through here if you're trading the actual flat top breakout. And you can see that every time it sets a new high and pulls back, the risk to reward ratios are changing. The sooner you're in based on a nice looking setup, the better. And this is my personal opinion, but you can see up through here that when price action gets really disconnected from that VWAP, you are then left with something like this. This is a bearish engulfing candlestick pattern, which ends up pushing price action back down to its mean, which in this case is the VWAP. So the general crux of what I'm trying to communicate to you today is I don't know that there's a lot of value in trading price action that is disconnected from the mean. You really want to get into a trend as it's starting to develop in its infancy stages, and that way when price action steps away from its mean, you're already in and you're already riding the profit train. But if you get in at a high when price action is extended from that mean, you have to understand that you're limiting your profit potential, you're increasing your risk profile, and I just don't know that that is the best way to be trading. I hope you like this video. I hope that some of this has helped. If you found it helpful, please like it and share it with another trader that you know that might need some help when it comes to trading. If you have any questions, by all means, please feel free to reach out.